All right, let's dive right into a topic that is causing a massive headache for hundreds of thousands of Australians, crypto tax.
You know, this quote from a Reddit user just absolutely nails the feeling, doesn't it? It's that sense of being completely overwhelmed. We're talking about a storm of transactions scattered across countless platforms, centralized exchanges, decentralized exchanges, wallets. It all adds up to this kind of digital shoebox of receipts that feels just impossible to sort through.
So, the big question is, how did we even get here? How did this incredibly exciting new technology turn into such a legal and financial nightmare for so many people? Well, that's the puzzle we're going to try and piece together today.
Okay, so first up, let's define the problem. Let's talk about the crypto tax nightmare. And really, it's a problem that comes from a clash of two totally different centuries.
See, on one hand, you've got your traditional assets, things like shares or property. We've had decades to build clear, understandable tax laws for those. But on the other hand, you have digital assets, a world of crypto, NFTs, and DeFi that moves at lightning speed. And we're trying to force this new tech to fit into those old legacy rules. One legal submission actually called our current tax law a hodgepodge that was built for a completely different era. And while investors are wrestling with all of this confusion, you can be sure of one thing: the Australian Taxation Office, the ATO, is definitely watching.
Just how big is this issue? Well, the ATO itself estimates that over 600,000 Australian taxpayers have already invested in digital assets. So let's be clear, this isn't some niche hobby anymore. It's a mainstream financial reality. Okay, now this is the absolute heart of the entire problem. The ATO classifies crypto not as currency, but as property. That single decision changes everything. It means that, in the eyes of the taxman, your crypto is an asset, just like a house or a stock, and it's subject to capital gains tax, or CGT.
And the ATO isn't just hoping people do the right thing. Since way back in 2019, they've had a data matching program. They get transaction data directly from Australian exchanges, they match it to your taxpayer records, and they look for things that don't add up. The whole idea that crypto is anonymous from the taxman here in Australia, that's a really dangerous myth.
But here's the thing. Just calling crypto property doesn't actually solve the problem. In fact, it just creates a brand new one. What even is a token?
You know, as the accounting firm PwC pointed out in a submission, you can't really write clear tax laws for something if you can't even agree on what that something is in the first place. And with crypto, that's probably the biggest hurdle of all.
This really shows that square peg round hole problem perfectly. We try to map all these different tokens onto old asset types, but they just don't fit. You've got a payment token like Bitcoin, but it's treated as property, which means even buying a coffee with it is technically a taxable event. You've got a utility token that's supposed to be like a voucher, but everyone trades it like an investment. Nothing fits neatly into the old boxes.
And to make things even more complicated, a token's function isn't even fixed. As PwC notes, a token can be transient. It can shift between being a payment method, a utility, or a security. So how on earth can you apply one rigid tax rule to an asset that's constantly changing what it is? So let's bring this down to earth. What does classifying crypto as property actually mean for the average investor? Well, it means an absolute explosion of taxable events.
It all comes down to this key term, a CGT event. That's just the official way of saying you disposed of an asset. And because crypto is considered an asset, a whole bunch of really common actions now count as a disposal, and each one needs its own calculation.
So even the basics can create a ton of work. Selling your crypto for Australian dollars, that's one. Trading one crypto for another, that's another one. Using it to actually buy something, yep, that's a taxable event too. Even gifting it to someone counts. Each one requires careful record keeping.
But believe it or not, that's the easy part. Because as soon as you step into the world of decentralized finance, or DeFi, well, the complexity just multiplies exponentially.
This is where things get really wild. For example, a super common action in DeFi is wrapping your Ether into something called WETH so you can use it in an app. The ATO considers that simple technical step a disposal and a new taxable event. The same thing goes for staking, bridging between blockchains, or providing liquidity. It creates an almost impossible to trace chain of transactions.
Okay, so the situation has become so unworkable that experts are basically demanding a complete rethink. It's a call for new rules built from the ground up.
And here's the contrast.
Right now, all we really have is some non-binding guidance on the ATO's website, which can change at any time, and laws that were written before Bitcoin was even invented. What experts want is a future with binding public rulings from the ATO and brand new fit-for-purpose laws designed specifically for this technology.
And there are some really practical solutions being proposed. Things like a safe harbor for small investors, so you only pay tax when you actually cash out to dollars. Or common sense rules that say technical steps like wrapping shouldn't trigger a tax bill. And crucially, they're calling for a proper forum where the industry and the regulators can actually sit down together and create rules that work in the real world.
So, where does all this leave us? What's the real path forward to actually get some clarity?
I think the key thing to take away from all of this is that this isn't just a record-keeping problem. This isn't something you can just fix with better software. The problem is deep and fundamental. It's a complete mismatch between 21st century technology and a 20th century legal framework that was never, ever built to handle it.
And that leaves us with one final, very big question. The technology that underpins our money is evolving at a breathtaking pace. Can our laws possibly hope to keep up?